Hey everyone, this is Dimitri Pragmatic with MarketChameleon.com. In this video, I'm going to go over a short example how to analyze a put option for early exercise. And we'll use SPY in this example. I'm going to scroll down here to the options chain, and we're going to pick out a put and then analyze if it is a candidate for an early exercise. I came out here on the September 29th expiration. We have the options chain in front of us, and this has 4 calendar days to go until expiration. And when we come down here, we want to look for a deep in the money put. You don't want to exercise a put that's out of the money or a put that already has time premium or premium over parity, because you're better off selling that put instead of exercising it. Because if you exercise it, well, then you gave up that extra time premium that you could have gotten for selling the put. So we're looking at a deep in the money put, and the put should be a 1 delta or 100 delta. In other words, the put is behaving just like selling short a stock. If the stock goes down $1, you should gain $1 in a put. If the stock goes up $1, you are expected to lose $1 in a put. So it's equivalent to being short the stock. And we're looking here for deep in the money puts as early exercise candidates. So let's take this one, for example, the 465 put. We see that this is pretty deep in the money. We could check the delta here. So the delta is 1. And I'm going to go here to the open interest, and we do see that somebody is carrying this position. And let's assume that we have this position on, and we want to decide, should I hold on to the put or exercise the put and convert it to selling short stock? Okay, and the idea behind it is, if you sold shares short, then you collected money for selling that stock, and that should earn you interest. That capital should earn you interest in your brokerage account, or you could use it to buy a treasury. But the idea is, if you're bringing money in, that should earn interest. And what we want to do is calculate, well, how much interest do we stand to make from being short the stock, and does it make sense to exercise that call? So first, I'm going to click on this put here, and what we want to do is calculate, in the next 4 days, what are we expected to earn in interest if we exercise this 465 strike? Okay, so I'm going to come down here, and after you click calculate, we added this interest calculator over here. And what we want to do is change the stock price equivalent to the strike. We have already 4 calendar days set up, and this is defaulted to the risk-free rate, currently 5.5%. So let's calculate that. And here we see that in the next 4 days, if we exercise and receive 5.5% annualized interest, that's equivalent to making 28 cents. Okay, 28 cents. Obviously, if you exercise, it's times 100, 200. So you could see that it would add up. Now, one thing we do give up, right, when we exercise this put, is that we are no longer limited to the risk of the strike. So if the stock does soar, let's say it goes up a lot past 465, and you're short the stock, well, now you have unlimited exposure to the upside. So to cover that risk, right, now that we're short stock, to cover that risk at the 465 strike, we could look at buying the call. And we see that this call is offered at 1 cent, 1 penny. So we could buy that option for a penny, because we stand to make 28 cents by earning interest on that short stock. And this appears to be a good candidate for an early exercise. Of course, you still have to check that it's not hard to borrow and there are no special corporate actions that you would want to remain in the put, but all things being frictionless, this looks like an a candidate for an early exercise. Hope you guys like this video and hope to see you guys in the next one. Bye.